Hi, folks. It's Charles Thomas from Intrepid Eagle Finance here to talk about what happened in the fourth quarter for the markets and the economy. I always like to start out with a little bit of headlines from the good side of things and some things we're looking on as more cautionary. First, on the positive side, US economy, labor markets still relatively strong. Good things there. Consumption is also still strong. So very strong GDP growth. Those are good things. When we look at the elevated yields among the bond market, it means that for the first time in a long time, when we look at fixed income, there's actually some income to be had. That's a positive thing. Then when we look out at some of the things that have been proposed by the new administration, what they're telling us is they're going to focus on growth and deregulation. So we shall see what comes of that. On the cautionary side, several things to note here. There's some talk around tariffs, immigration, taxes. We don't know what the impact of that is going to be. That remains to be seen, and what impact on inflation, if any, that will have. We're also looking at what the Federal Reserve is going to do in reaction to some of these things that are coming into play. What will their reaction be? Will they keep on the path they're on? Will they change focus? Will they keep the same, different? We shall see. The other thing to keep in mind is we're coming off an environment where we've had 2 years in a row where the S&P 500 has gone up more than 20%. That's unquestionably a good thing. The question becomes, do we get a third year of that? Or what does that look like? Do we go more back to the norm this year, or do we keep along with that streak? We shall see. And then lastly, looking at headlines, the geopolitical situation continues to be something that markets are paying attention to for what's going on in Ukraine, Russia, and the Middle East as well. Some numbers I want to share with you here. 4.25% to 4.5%. That's the new range where the Federal Reserve is operating in. They made rate changes in both December and November. And what they're still trying to do, this concept of what we call a soft landing, to where they're trying to get interest rates to an orientation that is okay for the economy long term, but still carries on with some of their goals of tamping down inflation. It remains to be seen whether they're going to achieve that goal that they've stated is on the table or not. 2.7, 2.4%, those are the inflation numbers for the last couple of months, respectively. Better than we saw a couple years ago, but that's still elevated from what the goal of the Federal Reserve is and what the long-term average is, looking back over the last couple decades. 67%. This is very notable. This is how much, if we're looking at the global stock market, how much of it is comprised of the US. We don't have to go back that far, only to about 2007 when it was 40% of the globe. Now, we've seen international stocks and US go up. We'll focus on that more in a couple of minutes. But that just shows you how much the US has outpaced the rest of the world and how much our markets have grown so much faster than everybody else, to the point where have been dominating the landscape. And you see that big difference for how much of the market we have overtaken there. 39%. Along the same lines, that's how much of the S&P 500 is made up of the top 10 stocks. Still very, very top heavy from that standpoint. Along the same lines, 55% of the S&P 500's return came from the top seven, what has come to be known as the Magnificent Seven. Overall, those stocks returned about 48% compared to the overall S&P 500, which returned about 23%. Still both monster numbers, but the Magnificent Seven has just done that much better compared to the broad market. Now, I could spend an hour here talking about all the things that happened last year because, boy, it was a lot. And in the collective memory, most people will probably tell you that the election and political landscape took up a lot of that. And while that certainly dominated headlines, plenty of other things to think about. Think about natural disasters, turmoil in overseas, things going on, continuing with inflation, interest rates, lots of questions there. And the list goes on and on and on. Big year from that standpoint. And we're transitioning from the questions we're asking. So we spent a lot of last year asking questions around what is going to happen with this election? What is going to happen with who controls the presidency, the legislature? Is that going to affect the courts? Is it going to affect the direction of the government? What's going to happen as far as who's in charge? Now we have answers to those questions, but now we're asking the question, what does that translate to in actual policies and actions or lack thereof in some cases? What does that look like? The questions have changed. We don't have answers yet, but we shall see. Now, one of those open-ended questions that's been bandied about a lot by the incoming president and a lot of our elected officials is around tariffs. Something we don't talk about a lot. And the thing about it is, tariffs are not new in one way of looking at it. We've had tariffs for a long, long time. Wanted to share with you this chart just describing the level of tariffs over time, going back to the early 30s when it was the last time this was a very big kitchen table type of issue. Tariffs got very high, then over time, the rest of the 30s they came down, and then most of of our lifetimes, if you're watching this, they've been relatively low. Now we've got this proposal out there, which is just that. There's no bill, there's no formal proposal out there yet. But if that went through, if you just go by what's been discussed, it would elevate those tariffs up to a level that we've not seen in a while. So the question becomes, what does that look like? How does that affect trade? How does that affect the markets, inflation, all those things? We shall see. Looking at inflation, we continue to see inflation above the long-term level of 2% that the Federal Reserve sets as a goal. But on the good side of things, if you look at where we were in mid 22, still dramatic improvement for that. So still a ways to go, but we celebrate how far we've come since then. So good and bad, a little bit of that. And when we think about the Federal Reserve, when you go look at their public statements and what they put out from their meetings, bond returns are all positive in the second quarter, but Treasury rates fell across the entire yield curve with a 1 month Treasury falling about half a percentage point. The 1 year fell a little bit over 1%. And when you look at that, the Fed, as you see here, has continued to use interest rates as their primary tool for attacking inflation and going after that. You see where things peaked up in the middle of toward the end of 23, toward mid 24, and then we started to see them stair step rates down. The Fed has said they're going to continue to monitor the situation. They will react to data as it comes in. We'll have to see what that actually translates to in their actions because at the end of the day, we pay attention to what they have to say, but what really matters are the actions that they choose to take or choose not to take. Looking at some parts of the market, one of the big impacts of those interest rates, be they go up, down, or stay the same, is the bond market. Bond market is very, very reactive to what interest rates are. When we look at that, bonds for the fourth quarter, for the most part, were down. But if we look out longer at what they did over 2024, up across the board there. And then what you see largely in the end of 2024 is reacting to those changes in interest rates and what that looks like. And we think about that yield curve and what that looks like. We've gotten closer to normal, but we're still not normal. When the Fed decreases rates, a common question is, how do U.S. stocks perform after a rate cut? It's a fair question. It's a good question. But the answer depends on why the Fed is cutting rates. Depends on why that is. So if you look at this chart over here, the S&P 500 move uses a proxy for US stocks. It's moved differently over various periods after cutting rates. So you think about periods like the dot-com bust in 2000 or coming out of the crisis in 2007, 2008. It's not surprising that the stock market fell following a rate cut. However, when the Fed is cutting rates because of what it deems more positive news, like falling inflation, it's possible stock market can increase. We've seen that as well. So what that's going to look like this time around, we shall see what that looks like. But remember, it's more of the reason behind it than and not just the action itself. When we look at one of the main markers that we look at in the bond market, it's the 10-year Treasury bond. And when we look at for that, we see how much that has moved over the fourth quarter. And that's largely where we saw that decrease in overall return come from. To see what that premium that we call it, how that has risen. It has to do a lot with the expectations of the markets for what they think the interest rates are going to do or what the Federal Reserve is going to do or choose not to do. And this measure is watched by a lot of the bond market. It's also when you think about kitchen table things that affect your family, like mortgage rates, that is one of the things that is very closely tied to this 10-year Treasury. So when you see the Federal Reserve lower rates, but mortgage rates go up, very closely mirrors what you're seeing here with what happened in November and December. Now, turning our attention toward US stocks. US stocks, if they had a year like 2024 every year, I would be very happy. We know we don't get that, but we celebrate it when we get it. And we got that in 2023 and 2024. When we look at just the fourth quarter by itself, markets were for the most part up with a few places where they declined slightly. But just long-term picture, very positive here. The question just becomes, can this continue or how long will it continue? What will that look like? And when we think about that question, that's where I want to point out. A lot of people like to prognosticate on that question about like what's going to happen this year. And it's good to remember how wrong forecasts often are. And I grabbed this to show how some forecasts turned out the past couple of years and what that looks like. When you think about what was predicted versus what actually happened, big difference, and they're rarely correct. Very rarely correct. So if you look up the farthest bar to the side in this chart, you see what the median analyst was looking at versus what actually happened. They way underpredicted that. So if you had followed this advice of these analysts, you would have probably had much less in the markets than you would have otherwise from a long-term plan. And you would have missed out on that giant, very pretty orange bar that went up into the 20% range. It would have been a miss just based on going by those prognostications. And just to put a little bit more of a laser focus on that, looking at last year, we look at that very top bar. That's what the markets did. The next bar is what the long-term average of the markets look like, the S&P 500. And then you look at all the predictions last year from a lot of these names you'll recognize from big financial firms. A lot of them predicted things would go up much less. A lot of them predicted markets would go down. And very few, if any, were right. So you've got this question. If you're going to listen to those predictions, one, you've got to have them be right every time. Then you've got to figure out who is going to be right. And then they've got to be right more than one time in a row. It's one of the reasons why I put very little stock in short-term predictions, and I don't think anybody should either. Now, to balance that out, I will show you the other side of that coin. When we look at one of the measures for stock valuation, it's called price to book ratio. So it's when we compare what the prices actually are in the market compared to what's on the books of these companies. When we look at that measure, historically speaking, they're a little bit more expensive than they have been in the past, or at least in the recent years. Now, does that necessarily mean a decline is going to happen, or we're going to have a worse year? What that looks like? Not necessarily. This is a this is merely a measure that's used to look at this, which is not by itself predictive, but it is still something that is something to note that relative to the recent past, stocks are more expensive than they have been. Now, you heard me mention earlier, and if you've seen this presentation earlier this year, I've mentioned a number of times about the Magnificent Seven. And this seven companies in the S&P 500 that got their moniker because they were doing so much better than the rest of everybody else. And although that has continued, what we've seen is returns have become much more democratized. It's been a much more broad gain in the market, and that's a good thing to not be as concentrated. Still concentrated, but not as concentrated. We've seen a number of other US companies come up and do better as of late, and that is a good thing. Now we're looking outside of the US at international markets. International markets did not do as well. They did not do as well for the fourth quarter. They didn't do as well last year. And there's reasons for that. But one thing I'll point out, just comparing the two, is if you look at how things went last year for international stocks, in any other year, we would be decently happy with this. This is a pretty decent year for for 2024. But by comparison, when we compare that to how well the US did, it just doesn't look as good. But even with that, I still believe there's a reason to hold international stocks, and that has to do with diversification. Still has to do that. The economy across the world is more intertwined now than it ever has been, but individual economies still have a lot of things that cause them to act independently, including their markets. And there's still value in that to help balance out the ups and downs we have in the US. And there's always a risk that one country, even ours, can have a bad year while economies outside of ours continue to do well. That's why we continue to hold US stocks along, complemented by international stocks. And then thinking about the the US dollar continues to be strong, which is a double-edged sword. We like it as consumers. It means that our dollars, when we're buying foreign goods, go much further. They have much more power, buying power specifically. But on the other side of that, as international investors, it means when you invest in something outside the US and those dollars come home, they lose a little bit of value on the return trip. So always remember, it's double-edged sword for that. So when we look at those international stock returns, they were hurt a little bit last year and the fourth quarter by how incredibly strong the dollar has been. And then lastly, I want to mention an anniversary that is occurring this year. And it's one that very few people know about. It goes all the way back to 1975. And just to give you the significance of this, up until 1975, the investing world was very different. And I don't just mean the lack of smartphones. The markets were very regulated as far as the prices that could be charged, and regulated to the point where prices that you were charged if you bought or sold an investment like a stock were fixed by the government. So between company to company, they could not charge any more or any less than what the government determined was acceptable. And what that meant was there was no price competition whatsoever. So get around to 1975, decision was made to deregulate those markets. And there was arguments at the time for and against that. The argument for it was competition is going to help the average investor. It's going to make this a lot better for everybody to have competition in the market. The argument against was that now these companies are going to run up the price. It's going to hurt everybody. It's going to take a lot of liquidity out of the markets. It's going to hurt things. And just to give you some perspective on the price difference then versus now, An average stock trade in the mid 70s, you paid around $50 for it. And that's $50 in 1975 dollars. So substantially more. So then we know what happened after that. Deregulation happened. Lots of companies came in and decided to start competing on price. And that has happened for the last 50 years to the point where prices have come down and approached zero in some cases. It also means it's a lot more people compared to 50 years ago can access the financial markets and invest that never could in the past. So it's been an overwhelmingly good thing. A lot of people thought this was going to be a disaster. It's turned out to be an overwhelming success to have this part of the market deregulated and have competition come in and do what competition does for the first time. And you'll, when May rolls around for the anniversary of this, it's called May Day in financial circles. Very few people will celebrate, but I will be celebrating because of the great impact this has had on the average investor. And lastly, just to cap it off, a couple of reminders about this. Financial planning is a process, it's not an endpoint. I think you should concentrate on long-term goals and objectives. You should focus on reaching goals, not beating benchmarks. Maintain a disciplined approach in the good markets, but also bad markets. Invest broadly and globally. Asset allocation is very important. And reduce investment and tax costs wherever possible. And then we rebalance as we necessary. And that takes us around to the end. So I want to thank you for joining me. Hope you have a great day. Hope the Lord blesses you and blesses your family. Thanks so much.